Welcome to another video of Cambridge Accounting. In today's video, we are going to solve October-November 2020 paper 12 A's and A-level paper. Let's move to the question. Question number 1. The inclusion of unpaid interest on loan interest in financial statement in accordance with accounting concept. When the business include financial interest, the unpaid loan interest in the financial statement, which accounting principle concept? So we can see consistency. Consistency means accounting records should be consistent in nature. So that is wrong. Going concern, continuity in nature, wrong. Yes, third option, matching is the correct answer. Next, what is depreciation? The first option, a means of allocating cost of non-current asset over its useful life. Perfect. That is the allocating of the cost of current asset over the entire useful life. So the correct answer is option A. Next, question number 3. A trader depreciates fixtures and fittings at the rate of 10% on cost means straight line method. On 1st January 2019, a purchase of new fixtures and fittings. What is the price of the item? The price is $5,000 was posted to the advertising account in an error. They are done one error, purchase of the fixed asset, they put as an advertising account. So advertising account, advertising is an expense. So what is the question? The question is, what was the effect of this error? Our question is, what was the effect of this error on the trader's capital account on 31st December? So first we have to calculate 31st December means closing capital. So first we have to know what is closing capital. Closing capital is equal to, this is closing capital. So closing capital is equal to opening plus profit. Opening plus profit. So here the profit is, first we have to check the opening capital plus profit. The effect of profit will change the capital account. So here the question, how it affect the capital account. So first we have to check how it affect the profit. So the here depreciation percentage is 10%. Actually it should be shown in the income statement. 10% of 5,000. 10% of 5,000 is how much? The depreciation is 5,000 into 10 by 100. Actually they should show depreciation 500, but they didn't show. They are, instead of that, the full amount has gone to the advertisement account. Advertisement, the full amount has shown. What is the amount shown? The amount shown is 5,000. Here 5,000 they are added, while by mistake 500 not shown in the income statement, 5,000 added. So this is not done, this is added. So the net effect is, what is the net effect? the net effect is in the income statement 4,500 is more in the expense. It means actually depreciation should be there 500, but by mistake advertisement shown, that means 5,000 overstated expense. That 5,500 we can adjust with the depreciation. So expense is overstated. Expense overstated 4,500. When expense overstate 4,500 means, what is the effect? What will happen when expense overstate? Expense overstate, profit will understate. So profit understate amount 4,500. So when profit is understate, what will happen? When profit understated, our capital will understate 4,500. So what is the correct answer? The correct answer is understated 4,500. Option C is the correct answer. Next, question number 4. A company had a non-current asset which cost 3,70,000 is the non-current asset. The asset had over 10 years useful life and an estimated residual value 20,000. A full year's charge depreciation is made every year. So, after 4 years, the asset was sold. After 4 years, the company sold the asset. The loss on disposal was 30,000 and disposal cost were 10,000. So, the total disposal loss is 30,000, but it include disposal cost 10,000. So the disposal time actual amount is 30,000 minus 10,000 cost. Disposal loss is actually 20,000 only there in the disposal. So here first we have the question is, what is the question ask? Question is asking what is the sales proceed or selling price. Selling price is equal to depreciation minus loss. The depreciation cost minus depreciation minus loss. So we can check what is the depreciation for 4 years. They are selling the fixed asset after 4 years. So after 4 years, what is the depreciation? First we have to calculate the depreciation. Depreciation is equal to 3,70,000 minus residual value 20,000 divided by what is the how many years? 10 years useful life 10. So 1 year depreciation is 35,000. So how much will be for 4 years depreciation? 4 years depreciation is 1,40,000 is the 4 years depreciation. Now we have to calculate the net book value. Net book value is equal to cost minus depreciation. So net book value is 3,70,000 minus 1,40,000. That is 2,00,000 how much is the amount? 2,30,000 is the amount after we deducted the depreciation from net book value. So we have to find the selling price. If the after deducted the depreciation, if the net book value is 2,30,000, then the net book value minus loss, net book value minus loss is equal to selling price. Selling price. So what is the loss? This loss is included with the disposal cost. So without disposal cost, it is 20,000. So 2,30,000 minus 20,000 is equal to 2,10,000 is the selling price. So the correct option is option D. Next, question number 5. Which item recorded on the debit side of sales ledger control account? Sales ledger control account is the debtors account. Increasing debtors on the debit side, decreasing debtors on the credit side. So let's check the items. Items are interest charged on overdue accounts of customers. If the customers are not paid the interest, then we will add the amount with their owing money. So it will increase the debtors amount. So the correct answer is option A. Next, question number 6. A trader prepared trial balance which did not balance. The difference was posted to suspense account. What is the question? The following have now been found. The errors: return inwards account overcast 90, payment of 200 rent had not been posted to the rent account, but cash is done. What was the opening balance? The question is, what was the opening balance of the suspense account? So first we have to prepare the suspense account. Suspense account. Suspense account, debit side and credit side. The first error 1, return inward. Return inward means sales return. Sales return, sales is always credit, sales return is always debit. The debit side sales return is overcast more than the actual value of 90,000. How to correct the error? So the sales return will be, always sales return is debit side. So if it is overstated means you have to put it on the credit side. So credit side you write sales return. So what will be debit? Debit will be suspense account. Suspense account is debit and sales return is credit. What is the amount? The amount is 90. Here 90, here 90. So here suspend account is debited with 90. So in the debit side 90 sales return. Next, the payment 200 for the rent had not been posted to the rent account. Rent is an expense. So the expense account, rent is an expense, all the expenses are debited. So we have to do the second journal entry. Rent is not ended means we have to do the rent now. Rent 200. So second journal entry, correction entry, rent account debtor 200, credit suspense account 200. So suspense account is credited with 200, rent 200. So what will be the opening balance? Opening balance will be the difference between these two. 200 is on the credit side, 90 is on the debit side. So the difference is coming on the debit side, 110. 110 on the debit side. So debit 110. So the correct option is B, 110. Debit is the correct option. Next, 7. How could a credit entry of 500 in X account have arisen in the books of Y? Y is preparing the books, he is preparing X account. So the journal entry, we don't know X is the customer or supplier, credit customer or credit supplier. So we can check the entry is coming on the credit entry. So we can show here two accounts we can show here. X as a debtor and X as the customer. Customer means debtor and X as debtor, then X as the supplier. Non-paid supplier is called creditor. So let's see how it is coming. There is a credit entry of 500. X bought goods from Y. If X is purchasing goods from Y, it means X is a debtor. If X is a debtor, it will show X is a debtor. So, if an X is purchasing goods, it is the debtor, debit balance will increase. So, if the option A, it will come on the debit side. So, credit entry, no, the first option is wrong. Next, X return goods to Y. If X is a customer, when X is returning goods, when X is selling, it will come on, X is purchasing, it will come on the debit side. X returned, the B option will come here. So the credit entry, the correct answer is X returned goods to Y. Next, an invoice for purchase was credited to purchase account. The credit purchase by mistake, they credited to purchase account. So actually purchase is debit. Here there are two mistakes. How will the balance on purchase account be corrected? Here the mistake is two types. The first mistake is the purchase is not debited. Debit. They are not debited. While what they are done? They have done the credit, they are done. Here, how to correct? The correction, we have to remove this and we have to add this. So, removing credit means you should put it on the debit side. Removing the purchase is not ended. Now, we have to first removing the credit. Removing the credit means we should add on the debit side. Then, we have to again enter the debit. So, 2 times we have to add the debit. So, the correct answer, the decrease in value, not decrease. We have to increase, add. So, first 2 option, no. Increase by the value of invoice, no. Then correct by twice increase the invoice. The correct option is option D. Next, question number 9. Question number 9. Rent is paid by a business monthly in advance on the first day of each month. The payment during financial year were as follows. Up to including 1st June. Until 1st June, they paid, what is the amount they paid? 500 per month. Till 1st June. From July, they are paid 600 per month. Which amount will appear in the financial statement for the year ended 31st October? So, if the account is closing by 31st October means it must be started from November 1st of the last year. So, we have to calculate what is the amount shown on the income statement and statement of financial position. Here, the question doesn't say any amount is prepaid or accrued. So, you have to just calculate what is the amount in the income statement. So, option A and B, first it's wrong. You have to check which option is going to the income statement. Here the question doesn't talk about prepaid or accrued. So, skip A and B. Now, the amount we have to calculate. November to June. November to June, how many months are there? In November to June? November to June, 8 months. 8 into, what is the amount? 500. 8 into 500, 4,000 is until November. Next, we have July to October. How many months? 4 months. But 4 months, what is the amount? 600 into 4. That is coming 2,400. The question is really easy. So, the amount 4,000 plus 2,400, 6,400. Correct answer is C. Next, question number 10. What is the effect on profit for the year and net asset when accrued expense are understated? Accrued expense. Accrued expense is the current liability of the business. Accrued expense in income statement, we will add accrued expense. In balance sheet, accrued expense, the expense amount is not paid. That is the current liability. It is the current liability. Current liability. So, the question is, if the accrued expense understated. If the expense understated, what will happen with the profit? Profit will be overstated. So the profit will be overstated. Profit is given to as overstated. So we have A and B. Next, net asset. Net asset means, what is net asset? Net asset is equal to current asset minus current liability. So if the liability is understated, the net asset, what will happen to the net asset? Net asset will overstated. So the correct answer is option A. Hope you are clear with today's solution. If you are not subscribed my channel yet, please subscribe and continue watching. Thanks for watching. AS level, winter 2020, paper 12, question number 11. Adil's trade receivables at 31st December 2019 were 26,500. He knew that $400 were irrecoverable, that is bad debt. He wished to maintain provision for doubtful debts 5% of the trade receivables. At January 1st, 2019, the balance of provision for doubtful debts was 1,200. Opening provision is 1,200. Which entry does Ali makes provision for doubtful account at 31st December 2019? Provision for doubtful accounts always enter in the income statement. So, if the provision for doubtful debts increase, if it is increasing because already they are given the opening provision. So, if it is, we have to check the provision is increasing or decreasing. Increasing will be debited in income statement. Decreasing will be credited in income statement. So, here trade receivables given 26,500. So we have to calculate this year provision. Provision always calculate after deducted the bad debt. Here the bad debt is given $400. So 26,500 minus 400 multiply 5%. After deducted the bad debt only, we always calculate the provision. So the amount is 1,305. What was our opening provision? Opening provision was 1,200. So it is decreasing or increasing? The amount is increasing. So how much is the increase? 1,305 minus 1,200. 105 is increasing. So increasing provision for doubtful debts, income statement account debited and provision for doubtful debts is credited. So here the answer is 105 credit, 105 debit, 105 credit. Income statement will be debit and provision for doubtful debts. Here the question is, the Ali make provision for doubtful account in 31st December. It will be credited. Correct answer is A. Next, question number 12. Adil and Bashir were in partnership. They were sharing profits and losses in the ratio 2:1. Chandra joins in the partnership. New partner Chandra is joining in the partnership. They three are sharing the ratio. What is the new ratio? New ratio is 3:2:1. The balance of partners' capital accounts prior to Chandra's joining. Adil and Bashir's balance they are given. Goodwill is to be valued 36,000 and not be retained in the books. What is the question? What is the balance on Adil's capital account after Chandra joined in partnership? Here, Chandra is the new partner, Adil is the old partner. When new partner is joining to the partnership business, old partners are sacrificing their goodwill. So, new partner goodwill will be debited in the capital account, and sacrificing partners, they have to get their portion of that goodwill, how much they are sacrificing. So first we have to check how much Adil is sacrificing when Chandra is joining. When Chandra is joining time, Adil is sacrificing. Before Adil's goodwill amount was Adil old goodwill 36,000 multiply old ratio 2:1. So Adil's portion is 2/3. So he was getting 24,000. But now how much Adil is getting? New goodwill. Adil is getting 36,000 multiply. What is the new ratio? 3:2:1. So 3/6 is equal to 18,000. Before he was getting 24,000, but now he is getting 18,000. So he is sacrificing. What is the difference? 24 minus 80,000. 24,000 minus 18,000. He is sacrificing 6,000. So what is our question? Question is the balance of partners' capital account prior to Chandra's joining, and what was Adil's balance on capital account. Adil's capital account balance, what is how much? So we can do the Adil's capital account. Capital account balance. Adil's capital account balance brought down 20,000, and he has to, the sacrificing partner's capital account will be credited. This is Adil capital account. So his sacrificing partners, the sacrificing portion will be credited. How much is sacrificing? 6,000. So here who has to give? Chandra's capital account will be debited. So Chandra's capital account, Adil will get 6,000. So what is the total amount? 26,000. So the correct answer is B. Next, question number 13. How is a loss on realization recorded when partnership dissolved? Options are given. Credit each partner's capital account. Loss means it will be debited. It will be taken from the capital. So no. Then debit partner's capital account. Yes, debit partner's capital account, but it's not equally. It will be on their profit sharing ratio. So credit, again given credit. No. Then the correct answer, debit each partner's capital account in their profit sharing ratio. The correct answer is D. Next, question number 14. John, Brian are in partnership, sharing profit and losses equally. John receives a salary of 2,000 per year. Brian loaned business 5,000. The interest of the loan is 5% per annum. Loan interest will be entered in the profit and loss account, while salary of the partner will enter in the profit and loss appropriation account. Now, the profit for the year before appropriation 24,000. Before appropriation means after profit and loss account. After profit and loss account means after adjusted the loan interest. Everything, the 24,000 is the profit before appropriation. And they are given the drawing of 3,000. What is the question? Question is, what will be the amount of residual profit? Residual profit means divisible profit of Brian will receive for the year. So Brian and John, they will share the profit equally. So he will get the residual profit one portion. So first we have to check the residual profit. Profit before appropriation is 24,000 and partner's salary is 2,000. We have to deduct. Loan interest only enter in the profit and loss account, not in the profit and loss appropriation. So here the residual profit is equal to 22,000. So two partners, they are sharing equally. So the Brian share will be divided by 2 is equal to 11,000. So the correct answer is 11,000. Next, question number 15. A company issued 1,000 ordinary shares of 1 each. The price of the share is 1, but they are issuing at a premium. So they will get the cash 100,000 into $3. The market value was 4 per share. Which statement is not correct? Here capital reserves increased by 2,000. This is correct because capital reserve premium they are issuing at 2. So 2 multiply 100,000. 200,000 will be capital reserve increase. Cash and cash equivalent increase. The company is collecting amount 2 plus 1, 3. 3 multiply 100,000, 3 lakh. That was also correct. Ordinary share capital increase 100,000. Yes. The ordinary share price is 1 and the capital is 100,000. It is increasing 100,000. Next, revenue reserves increased by 4 lakh. This is wrong because revenue reserve is when the company is issuing the capital, there is no revenue reserve. That is capital reserve only. So option D is wrong. So the correct answer is option D. AS level October-November paper 2020, paper 12. Question number 16. Which item has no effect on the total equity of a limited company? Equity of a limited company means total shareholders fund, share capital plus reserves, premium, retained earning, etc. So which is not affecting the equity of a limited company? They are given options: bonus issue of share, dividend paid, right issue of share, upward revaluation of non-current asset. revaluation profit or revaluation reserve, it will go to the limited company shareholders fund. It will make the changes. Right issue of share will increase the share capital. That also will bring the changes in the limited company's equity. Dividend paid will decrease the retained earning. So that will bring the changes in the limited company. But bonus issue of share. Bonus issue of share means company issue fully paid up shares to the existing ordinary shareholders. So that will change, the capital will increase and the money will adjust from reserves and surplus. So the all are in the same amount. That means capital amount will increase, reserves and other surplus amount will adjust, it will decrease. So it will not bring any changes in the equity of limited company. Correct answer is E. Next, information relating to W Limited for the year ended 31st December 2019. They are given retained earning, profit from operation, dividend paid, dividend proposed, bank loan interest. What is the question asking? What was the amount of retained earnings at 31st December 2019? Question is asking what is the closing retained earning. They are given the opening retained earning. So closing retained earning is equal to opening retained earning plus current year retained earning. So we have to calculate current year retained earning. Current year retained earning is equal to profit after interest and tax. Profit after interest and tax, here profit from operation is given 83,000. Dividend paid 20,000. Dividend proposed. Dividend proposed means that is not paid, just proposed. We will not deduct from profit. Bank loan interest. So profit after interest and tax. So deduct dividend paid, bank loan interest. So what is the amount? 83,000 minus 20,000 minus 16,000. The amount is 47,000 is the current year retained. And opening retained earning. What is the opening retained earning? 22,000. So 47,000 plus 22,000 is equal to 69,000. Correct answer is option D. Next, question number 18. Which financial information is not available for potential shareholders of a limited company? Potential shareholders of a limited company will get the financial information like income statement and balance sheet. So here the options are given: cash budget, income statement, notes to financial statement, statement of changes in equity. Statement of changes in equity is the part of balance sheet. So this will be available to shareholders. Note to financial statement is the extension of final account. It gives the explanation about the balance sheet. So that also available to them. Income statement, definitely it is available to them. So cash budget, that is the financial estimation in the future, financial estimation like cash inflow or outflow. That is not available to the shareholders. So correct answer is cash budget. The answer is easy. Question number 19. Following information is available. Revenue 600,000 given. Opening inventory, purchase, closing inventory, gross profit, expense, profit from operation. They are given one income statement. What was the rate of inventory turnover? Rate of inventory turnover. The question is, what is the inventory turnover ratio? In times. Inventory turnover in times is equal to, what is the equation? Cost of sales divided by average inventory multiply 100. Here the cost of sale is given, but we have to calculate the average inventory. So, average inventory is equal to opening inventory plus closing inventory divided by 2. That is, opening inventory is how much? The opening inventory 46,000, closing inventory is 50,000. So, 46,000 plus 50,000 divided by 2 is equal to, average inventory is equal to 96,000 divided by 2, 48,000 is the average inventory. Now we can apply this into the equation. Cost of sales. What is the cost of sales? Average inventory is 48,000. So cost of sales is given opening inventory plus purchase minus closing inventory is equal to cost of sales. Cost of sales is given 240,000. So 240,000 divided by average inventory 48,000 multiply 100 is equal to no need to multiply with 100. This is in times. So we have no need to multiply with 100. Equation 1 changes. There is no need to multiply with 100. So we have to only cost of sales divided by average inventory is equal to 5. Because it's in times, so no need to multiply with 100. So the correct answer is B. Next, question number 20. A company's financial statement for the year ended 31st December showed the following: issued share capital, non-current liabilities, reserves including retained earnings. The company's profit from operation is given 160,000 and the profit for the year is 120,000. What is the difference between profit from operation and profit for the year? Profit for the year means profit after interest, tax and dividend. But profit from operation means the actual profit of the company, like sales minus cost of sales minus other expense. That is profit from operation. What is the question? Question is, what was the company's return on capital employed? return on capital employed is equal to ROCE. ROCE is equal to net profit before interest and tax or profit from operation divided by capital employed. Divided by capital employed. Capital employed is equal to capital plus long-term liabilities. Capital employed is equal to capital plus long-term liabilities. Long-term liabilities. So here, what is the net profit? Net profit means net profit before interest and tax or profit from operation. Profit from operation is given in the question. That is 160,000 divided by capital employed. Capital employed is equal to capital plus long-term liabilities. What are the capital here? Capital is given. Issued share capital 150,000 and reserves and surplus. This company's capital means capital plus reserves and surplus and premium, etc. So here capital is 150,000 plus 250,000 plus long-term liability 280,000. So the total capital employed is equal to 150,000 plus 280,000 plus 250,000. That is 680,000. So capital employed is 680,000 multiply 100. Net or profit from operation divided by capital employed into 100. So what is the correct answer? 23.5%. Correct answer is A. October-November 2022, paper 12. The last part we are going to do today. Question number 21. Which cost can be classified as fixed cost? Fixed cost means the cost which will not change. So they are given the answers like bank overdraft interest. Bank overdraft interest will change. That is not the fixed. Piece rate labor cost. It will change depend on the number of pieces. Sales commission always gives on the sales. How many sales are given? That also not fixed. So the correct option telephone rental. Telephone rental is classified as a fixed asset. So the correct answer is option D. Question number 22. An employee works 40 hours a week at an hourly rate $8. She receives bonus of 30% of the hourly rate. She will receive the bonus of the 30% of hourly rate when time saved producing each unit. If she save any time on each unit, produce the extra time what she saved, she will get the amount of 30% of the total hourly rate. the target production time is 30 minutes per unit. If she could produce less than, the employee could produce less than 30 minutes, she can save the bonus amount also. Last week, she worked 40 hours and produced 90 units. What were her gross earning? The question is to calculate gross earning for the week. What is her gross earning for the week? So let's do the problem. The first one, how many hours and how many units she produced? How many hours she produced and how many units? It means they are given 40 hours she has taken to produce 90 units. So first we can check how many hours required to produce 90 units. To produce 1 unit is, what is the timing? To produce 1 unit, they are given the time 30 minutes required to produce 1 unit. So to produce 90 units, how many minutes required? To produce 90 minutes, 90 multiply 30, that is 2700 minutes required. 2700 minutes means divided by 60, how many hours? 45 hours required to produce 90 units. But the employee produced this within 40 hours. So how many hours he saved? He saved here 5 hours are saved. 5 hours saved. So each saved hours, how many they will get? If he saved any time, he will get the bonus of, how much is the bonus? 30% of the hourly rate. 30% of the hourly rate. So 5 hours, what is the payment of 5 hours? Per hour 8. So 5 multiply 8 is equal to 40 hours. So 40 hours 30%. 40 hours multiply 30% means 30 divided by 100. $12 extra he will get. So the question is, what were her gross earning for the week? Extra he will get 12 and actual amount is how much? 40 hours he worked. So 40 multiply 8. $320 is the hourly payment plus bonus is 12. So total is 320 plus 12. 332. So what is the correct option? Option B is the correct answer. Next. A business uses weighted average cost method to value its inventory. If purchase the following units of inventory, they are given the units, cost per unit, total cost. After these receipts, it issued means sold 250 units to production. What was the value of the issue? Value of the issue means unit into price. Unit into price is equal to how many units? Unit is 250. multiply. What is the price? We don't know the price. So we have to calculate, we have to find the price. How to calculate the price of AVCO? How to calculate the unit price in the time of AVCO? AVCO unit price is equal to total units divide total value, total cost divided by total number of units. Here what is the total cost and total number of units? Total cost is given 3,600 plus 5,760 plus 4,320. The total is 13,680. What is the total unit? 100 plus 120 plus 80 is equal to 300. So, we apply this into the equation. Total cost is 13,680 divided by 300 is equal to 45.60. That is the unit price. So now we can apply this in the price. 45.60. What is the answer? Answer is 250 multiply 45.60 is equal to 11,400. So the correct answer is option B. Next. Question number 24. A business provides the following information: month, number of machine hours, overheads. The variable overheads rate per machine hour was 4. What was the monthly fixed overhead cost? The question is, what is the monthly fixed overhead cost? So here, the amount is 34,000 and 67,000 is given. The number of machine hours 34,000 and in April 67,000 in May. In overhead they are given 493,625,000. So first we have to find what is the amount, the variable cost. The total cost is equal to variable cost plus fixed cost. So here the question is to calculate the fixed overhead cost. So the overhead cost is 493,000. This is included fixed cost and variable cost. So first we calculate what is the variable cost of the 34,000 machine hours. So variable cost is equal to 34,000 multiply 4. 34,000 multiply 4 is equal to 136,000 is the variable cost. But what is the actual cost given here? The actual overhead cost is given 493,000. So the remaining amount is fixed cost. So fixed cost is equal to total cost divided by total overhead divided minus Variable cost. Total cost is how much? 493,000 minus 136,000. What is the correct answer? 357,000. So the correct answer is answer option D. Next, question number 25. A business absorbs its fixed overheads using direct labor hours. The following information is provided. They are given actual and budgeted. Overhead they are given, labor hours they are given. What statement is correct? Here they are given overhead absorbed, underabsorbed or overabsorbed. Underabsorbed means if the budgeted overhead is less than the actual overhead, that is called underabsorbed, while if the budgeted overhead is more than the actual overhead, that is called overabsorbed rate. So first we have to check what is our absorption rate. Here the budgeted was 12,700. The overhead was 508,000. So first we have to calculate the budgeted overhead rate. Budgeted overhead rate is equal to 508,000 divided by 12,700. How much it comes? That is 40. 40 is the budgeted overhead rate. Next, now we have to calculate the budgeted overhead rate to produce the labor hours 14,300. The 508,000 is the budgeted overhead for 12,700 unit. So what will be the budgeted overhead rate for 14,300 flexed budget? That is 14,300 multiply. The budgeted rate is 40. The budgeted rate is 572,000. This is 572,000. But what is actual overhead rate? Actual overhead rate is given 600,000. But the budgeted overhead rate for 14,300 labor hours is 572,000. So that is increased or decreased? The budgeted is less. Budgeted is less. Actual is more. So this is the budgeted. Actual 600,000. So 600,000 is more. How much is the more? So budgeted is less. Actual is more means under absorption. If the budgeted is less, actual is more, it means under absorption. So what is the difference? 6 lakh under absorption is equal to 600,000 minus 572,000 is equal to, what is the amount? 28,000 underabsorbed. So the correct answer is overhead were underabsorbed 28,000. Option B is the correct answer. 26. A company sells single product 24 per unit. Selling price is 24 per unit. The variable cost given $8 per unit. Selling price $24. Variable cost 8 per unit. Now, fixed costs have been absorbed based on normal activity level. 1000 units, 6 per unit. It means fixed cost will be each 1000 units they are calculating. So that is 6 per unit. So what is the profit under marginal costing if the company makes and sells 1250 units? So the profit under marginal cost is equal to marginal cost profit is equal to sales minus variable cost is equal to contribution, then contribution minus fixed cost. First we calculate the contribution, then contribution minus fixed cost is the profit as per the marginal costing. So what is the contribution here? Contribution is given 24 is the selling price, 8 is the variable cost. So contribution per unit is equal to 24 minus 8, that is 16. So to produce 16, when the company produce 16, what will be the contribution to produce? 1250 units. What will be the contribution? 1250 multiply 60 is equal to 1250 into 20,000. What is our question? What is the profit? What is the profit under marginal costing if the company makes and sells? So now the contribution is 20,000 minus fixed cost. We have to calculate the fixed cost now. We are just calculated the contribution. So fixed cost is equal to, here to calculate, here the fixed cost is given for 1000 unit, 6 per unit. Here we have 1250 unit. They will calculate the fixed cost 1000, 2000, 3000, each 1000 unit. So we have to take the fixed cost 1000 unit only, 1000 into 6. 6000 is the fixed cost. So contribution minus fixed cost is equal to profit. So 20,000 is the contribution minus 6,000 is the fixed cost is equal to 14,000 is the profit as per marginal costing to produce 1250 units. Option C is the correct answer. Next, 27. A product has the following revenue and cost per unit. They are given selling price, marginal cost. What is the contribution to sales ratio? Question is contribution to sales ratio. So first we have to do the equation to calculate contribution to sales ratio. So the equation contribution to sales ratio is equal to contribution divided by sales into 100. So we have to do the contribution. Contribution is equal to sales minus variable cost. Sales minus variable cost is equal to, here the sales is given 40. Variable cost means marginal cost. This is variable cost 22. So 40 minus 22 is equal to 40 minus 22 is equal to 80. And now we can apply to the equation C by S. C by S. C is the contribution is 80. Sales is 40. So 18 divided by 40 multiply 100 is equal to 45%. So the correct answer is C. C is the correct option. Next, 28. Which statement about cost volume profit analysis, CVP analysis, are correct? It applies over any period. It applies over any period. No, it is in the time of marginal costing. This first option is wrong. It's suitable for any range of output. No, it is not suitable to any range of output. Then profits are calculated using marginal costing. Yes, as per marginal costing, we check the cost and the change in the volume. When the change in volume, what is the cost? Then when the change in the cost, what will be the profit? The analyzing of these three changes study. So the correct option is 3. So which option? 1 and 2, 1, 2, D. The 3 only, the point 3 only is the correct answer. Next, question number 29. Total cost at 2 level of production are as follows. 10,000, 16,000, and they are given the level of production cost. Cost is given and unit is given. Fixed cost will increase. Here they are saying something. Fixed cost will increase by 30,000 when if the units are produced more than 20,000 units. What were the total cost? They are asking the total cost to produce 25,000 units are produced. So if it is increasing more than 20,000 unit, it will be increasing the fixed cost 30,000. Then what it will be if there is 25,000, it will increase 30,000, right? Because the rule is more than 20,000. So what all we have to do here? First we have to calculate the fixed cost and variable cost. The first step, calculate fixed cost and variable cost. Then we have to just apply to the equation. So to know the variable cost, here they are given to 10,000 unit cost, 16,000 unit cost. Both units, the fixed cost will be same, but only what will be the variable? Variable cost only will change, fixed cost will not change. So if to produce 10,000, 230,000, while to produce 6,000, 320,000. So to produce extra 6,000, when it become from 10 to 16,000, what is the amount to produce extra 6,000? That will be our variable cost. So we can calculate first variable cost per unit. So here to produce 6,000 extra, how much extra we are spent? 230,000 minus 320,000 and 16,000. So, to produce 6,000, our cost is 230,000 minus 320,000. So, extra cost 320,000 minus 230,000, that is 90,000. 90,000 is the cost to produce 16,000 minus 10,000, that is 6,000. So, to produce 6,000 extra, 90 is the cost. So, what will be the cost per unit? 90,000 divided by 6,000, that is 15 is the variable cost per unit. You are clear? This is the variable cost per unit. So, now we can calculate what is the fixed cost. If the 230,000 to produce 10,000, what will be the fixed cost? First we calculate 10,000. What is the variable cost to produce? Then the extra amount will be the fixed cost. So here variable cost 10,000 production variable cost we calculated 15. That is 1,50,000. But the total cost is given here 2,30,000. So 2,30,000 minus 150,000. 230,000 minus 150,000 is equal to, that is our fixed cost, that is 80,000. So fixed cost is, we calculated 80,000. So now we have to apply this into our question. 25,000 unit. What is the variable and fixed cost? 25,000 unit production. 25,000 multiply variable cost is equal to 50 is equal to 375,000. Next, what is our fixed cost? Fixed cost is fixed to all the unit. Whatever the unit, when the unit change, only variable cost change, but fixed cost never change. Here as per the question, if it is increasing more than 20, they will add 30,000 with fixed cost. So here we have 25,000. So our fixed cost is equal to 80,000 plus 30,000 because our units are more than 20. So 30,000 is equal to 110,000. So the total cost to produce, our question, total cost to produce 25,000 is equal to 375,000 plus 110,000, that is 485,000. So the correct answer is B. Now the last question. Which are benefits of a budgetary control system? The budgetary control benefits. It can be used to control expenditure. Yes, the budgetary control, it will help the business to control the future expenditure and current expenditure. It can be used to record accounting transaction. No, budgetary control is not used to record accounting transaction. It will not help. because budgetary control only mainly it is showing our cash transaction. It can help when applying for a loan. Yes, business can check. It can identify where improvement are required. They know how to do the budgetary control. So the correct answer options 1, 3, 4. The first one wrong, second wrong. Yes, option C is the correct answer. Hope you are clear with this video. This was a subscriber requested video. Hope you are 100% clear with all the solution. If you are not subscribed my channel yet, please subscribe and share with your friends who are doing AS level accounting. All the best on your coming examination May-June session. Thanks for watching.